This is Demystifying Taxes for grad students and postdocs. My name is Emily Roberts. My business is personal finance for PhDs. And I'm presenting this webinar as basically a service to the community that I came from, the PhD community, because I know that taxes are a huge pain point for grad students and some classes of postdocs. So we'll get into lots more about that momentarily. But I want to start off by telling you a tiny bit more about myself. So as I said, my business is personal finance for PhDs, and you can find that at pfforphds.com. I have a PhD in biomedical engineering. I finished up at Duke in 2014, and I've basically, after that point, after I defended, I launched my business, Personal Finance for PhDs, and through that, I speak at universities, so many of you may have found out about me because I gave a seminar or a webinar for your university. I also do a lot of writing for my own website and for others on the topic of personal finance for PhDs. I coach, I'm a financial coach, and I also teach. I create courses on the subject of personal finance for PhDs. And so specifically the groups that I serve are prospective graduate students who will be receiving stipends during graduate school, graduate students who receive stipends, postdocs, and early career PhDs, which I kind of just term like anyone with a PhD who's in their first or so job out of the PhD. So I've been doing that for a few years. I really love it. And you all are on my mailing list now, so I'm not going to belabor any of these points, and we're going to get right into the presentation. So this is what we're covering in the webinar today. Very briefly, some basics about the tax code, some vocabulary, some really basic concepts that are important to understand, the common tax preparation methods that I see grad students and postdocs using, the pay types that you may receive during those stages in your training and their associated tax forms. Then we're going to have kind of a long and complicated section specifically for graduate students, which is about calculating the graduate student income that you actually need to report on your taxes and how to use your education tax benefits. So postdocs, I'll tell you kind of when you can tune out and when you need to tune back in because the education tax benefit section doesn't apply to you, but everything else that we talk about will. But graduate students, if you want a deep understanding of what's going on in your tax return, that is the key section there. After that, we'll move on to talking about reporting your income or incomes on your tax return, paying estimated tax for those of you who have not had tax withheld. I'm going to show you a couple featured tax lies from my tax lies series. And finally, I'll talk about some changes that are upcoming in 2018. So all of the presentation today is for your 2017 tax return. But of course, we just saw that a major tax bill was passed in December. And so there are a few changes for 2018 that are relevant for everyone. So I'll go over those really briefly. And the entire purpose of what we're doing today is to take you from feeling like this guy about your taxes to feeling like this lady who is strangely excited to be working on her tax return. And so I'll just make a note about questions throughout the presentation. So I do anticipate this to go perhaps an hour or a little bit longer than an hour just to get through the presentation itself. And I'm going to be pausing sort of after each section, and I'll invite questions at that time from you all. So you can submit your questions in the chat window, and I won't be monitoring that like while I'm presenting, but I'll check it out in between these sections, so you can pop in your question when you think of it, or when I invite the questions, and I will try to answer at that time. I would really like to keep it to clarifying questions during the presentation, like I didn't understand what you were saying there, or can you go over that again, or like what about this extension of that situation, and of course any like complicated questions that'll kind of veer us off track, I'd like to leave those for the end of the webinar, and I will stay on the line and take questions afterwards for quite a while. I have quite a bit of time, so you can certainly save them for that point. So moving into our first section. Oh, before we get started, really, I need to tell you some assumptions that I'm making about you as my audience members and some of the limitations of the presentation. So what I'm imagining, who you are as my intended audience of this presentation, you are a domestic US graduate student or postdoc, so you are a US citizen or a permanent resident, and at those levels of training. You have your income coming from wages, fellowships, scholarships, those types of academic related sources of income. You have a relatively low income. You are probably in the 0 to 15% marginal tax bracket, or maybe up into the 25% tax bracket. And you're not being claimed as a dependent on anyone else's tax return, so not on your parents' tax return this year for 2017. And you are in need of resources specific to your income and education expenses as a trainee. So I'm not telling you everything there is to know about filing your tax return today. I'm really focused on the aspects of your tax return that are directly related to your income and expenses as a graduate student or postdoc. You can find out more general tax information from many other places, but I'm providing you the information that's a bit harder to find specific to your role as a graduate student or postdoc. So the limitations of the presentation are that it does not cover other kinds of income that you might have, like investment income, rental income, self-employment income, if you had another type of job. Doesn't cover those types of income. It does not fully address tax breaks that are not related to the educational tax breaks that I will be covering. I'm not addressing the phase outs for instance, some of the tax benefits that I'll be talking about. So what I mean by that is that sometimes, like for the education tax benefits, if your income reaches a certain level, you're no longer eligible to take that benefit. I'm not addressing what those phase out limits are exactly, because I'm assuming that you are, as I said earlier, in a lower tax bracket. Those are not going to be relevant for you. But if you do have a higher income, for instance, if you are unusually well paid for a graduate student or postdoc, or if you're married to someone who has a much higher income and you end up in that 25% tax bracket or above, you may need to check into whether or not you're actually eligible for these benefits because your income may be a bit too high. So last note before we dive into the material, this material is for information purposes only, educational purposes. I'm not giving individual tax advice. I'm not a professional tax preparer. As I said, I do not know everything about the tax code. I'm not covering everything about it. I've just really studied in depth this material that's relevant to graduate students and postdocs. That's what I'm limiting the presentation to. So your tax return is still your responsibility entirely. Oh, if you want a cheat sheet, some of you may have already downloaded this, but I do have available on my website a cheat sheet for domestic grad students. So it's like a 2-page sort of note sheet that summarizes what we're going over today. So if you'd like to grab that, you can find it at the URL that I've listed on this slide. Okay, so let's get into the basics of the federal tax code. We're talking about deductions, credits, and marginal tax brackets momentarily, just so we're all on the same page with those terms, because they're going to come into play a lot later on. So this comic says the tax code isn't as complicated as most people think it is. Anyone with a staff of accountants and legal experts can figure it out, which is sort of a bleak view of taxes and sort of a bleak view of our government. But we're going to be keeping it fairly simple today, and I'm going to point you to resources that are pretty easy to consume. And so I do think it's possible to figure out the aspects of your taxes that are relevant to your income and expenses as a graduate student or postdoc. I'm going to break it down for you today, and so hopefully you'll come away with a great understanding and no need for a staff of accountants to help you prepare your return. Okay, so I'm going to run through kind of a quick example of how your income sort of flows through a hypothetical tax return that you might file for someone with a really simple financial situation. And so the numbers that I'm using are just examples, they're hypotheticals, and they're also for a single person. The numbers that I'm using in this example are for a single person. So let's say that you had a total income of $30,000 for the year, and that's the purple bar right there. The first thing after you calculate that income, you're reporting that income on your tax return, the first thing that will happen after that is that you will take some above the line deductions. And so these deductions are termed above the line. They are available to anybody, not just people who itemize their deductions. So let's say this person takes a deduction, an above the line deduction of $1,000. That means that their taxable income is going to go down to $29,000. So some examples of above the line deductions are student loan interest. Many of you may be are familiar with taking a deduction for the student loan interest that you pay, if you contribute to a traditional retirement account, or if you are paying any self-employment tax, those are also examples of above-the-line deductions. So what a deduction does is it reduces your taxable income. So with a $1,000 deduction above the line, you're going from a $30,000 taxable income down to $29,000 taxable income. And that's your adjusted gross income, or AGI. And your AGI comes into play in quite a few other places. So it's really useful to know that or know approximately what it is. So now we're down to a taxable income of $29,000. The next thing that we do is that we take another set of deductions. I term these kind of below the line deductions to be, parallel to the above the line deductions. I don't think anyone else calls them that, but this is going to be the standard deduction or itemized deductions. And so for a single person, 2017, the standard deduction is $6,300. That's another chunk of your income that you don't have to pay tax on, that it's going to be untaxed. And you would take the standard deduction versus itemizing your deductions if those itemized deductions would not add up to as much as the standard deduction does. Versus, in contrary, if you itemize your deductions and they end up to be more than the standard deduction, then you're welcome to itemize your tax return, and that'll further reduce your taxable income. So some examples of itemized deductions: medical expenses that exceed 10% of your AGI, state and local taxes, home mortgage interest, and charitable gifts, all examples of deductions that you can itemize. But again, you would only itemize if those deductions altogether would add up to more than $6,300 for a single person. And only in the years leading up to 2017, only about 1/3 of households itemize their deductions. And so most of you, I would imagine the vast majority of you, are not itemizing. So you'll be taking the standard deduction. So the next thing that happens in 2017, at any rate, is that you are going to take an exemption. For a single person, you would get one exemption. For a married couple filing jointly, you would get one for each of you. If you have dependents, you would have more for your dependents. But basically, it's another chunk of your income that is not taxed, your exemption. $4,050 for a single person in 2017. So now we get down to, finally, your taxable income of $18,600 from this hypothetical $30,000 starting total income. Next, what happens is we apply the marginal tax brackets. So you're going to pay 10% tax on that first chunk of taxable income, and that's from $0 to $9,325. You'll be paying 10% tax on that chunk. And then on the next chunk, going up to $37,950, you're going to pay 15% tax on that chunk. So you have a chunk of your income that is not taxed at all, a chunk that's taxed at 10%, a chunk that's taxed at 15%. And so if you run those numbers, from that 10% chunk, you're going to pay $932.50 in tax, and from the 15% chunk, $1,391.25. So that adds up to a calculated tax of $2,325.75. So the next step in our hypothetical return here is that this person is going to take a credit, for example, of $1,000. And so a credit directly reduces the amount of tax that you have to pay. So the taxable income goes from $2,300 down to, or the tax goes from $2,300 down to $1,300 at the end of this kind of example illustration. So let's review the terms that we went over. Deductions reduce your taxable income. And so what they are worth is your marginal tax bracket, 10%, 15%, wherever you top out, times the deduction amount. So if you have a deduction of $4,000 and you end up in the 10% tax bracket, that deduction is going to be worth $40 off of your ultimate tax due. Versus a credit reduces your tax directly. It's worth its face value. If you have a $1,000 credit, you're going to take $1,000 off your tax due. Deductions reduce your taxable income, credits reduce your tax. Above the line deductions are available to everyone, not just people who itemize their deductions. You can choose the greater of the standard deduction versus itemized deductions for that set of deductions that you'll take. And it's pretty likely that you'll be taking the standard deduction, I would imagine. This is kind of good news because itemized deductions are what a lot of people complain about with respect to preparing their taxes every year, because you have to keep track of it throughout the year, what all your expenses are, which ones you can deduct. It's a little bit, tedious. And so it's kind of nice to be able to take the standard deduction, have that be the most advantageous for you. Your tax bracket is the highest marginal income tax bracket that applies to you. As I said, probably it's going to be that 10 or 15 or 25% tax bracket for most of you. Whereas your effective tax rate is the percentage of your gross income that you actually paid in income taxes. So that's going to be the amount of tax that you paid divided by your total income. So a lot of people have this misconception about the tax code that whatever tax bracket you top out in, let's say 15%, you're paying 15% of all of your income in tax. And that's not the case, as we saw. You're going to pay 0% on part of your income, 10% on part of your income, 15% on part of your income. So you top out at 15%. But that's not how it is the whole time. So we're getting into the next section. So I'm just going to pause here. And if anyone has questions on this previous section, just pop them into the chat. And yeah, I will address them as best I can. Just wait for a few moments. Okay, so the question from Jessica is, you said that you can claim student loan interest as an above the line deduction. Is that for previous loans or current loans? It's for loans, it's for loan interest that you pay during the tax year that we're talking about. So in this case, 2017. So your loan servicer should send you some kind of tax form. I think it's a 1098E, if I'm not mistaken. And that will tell you the amount of interest that you paid, and that's the amount of the deduction that you can take. I'll just wait another couple moments here, see if there's any more questions coming in. Okay, question, should tuition be used as a deduction or credit? We are going to get into that. Do not worry. We're addressing it a little bit later on in detail. You will be satisfied. Okay, I'm going to move on to the next section now. And after that, of course, I will pause again for additional questions. So tax preparation methods, another comment here. I love this new tax software. It's amazing. Oh, sounds like it's very accurate. Accurate? It's more than accurate. It lets me hide everything. This is not the attitude that I want you to take towards preparing your tax return. It should be about preparing an accurate tax return, not trying to pay the absolute minimum tax you can possibly get away with justifying through devious methods based on how you prepare it. So that's not the goal. The goal is accuracy. And so there's three methods that I see most commonly graduate students and postdocs using. The first one is that some people do actually prepare their tax returns themselves by hand or manually. I did this myself from time to time during graduate school, and it's not necessarily as difficult as you might think if you have a very simple financial life. And to make it easier, you don't actually literally have to print out paper and fill it in with ink. You can use the free fillable forms through the IRS website, which are fillable PDFs. So that is a pretty easy option for you. So you can prepare your tax return yourself, and I saw that at least one person was considering attempting it during the chat we had before the webinar started. By far, the most popular method for preparing your tax return is going to be software. TurboTax, TaxAct, many other options. I just want to point out to you that the IRS itself offers tax software called the Free File System, and it's for people who have a lower income. Graduate students certainly qualify, postdocs probably qualify. So you can check that out if you are not interested in paying for other tax software. So that's an option. I do think it's a little bit tricky to use tax software, and the next method that I'll talk about, using a professional tax preparer, they're both what I call garbage in, garbage out methods. So you do have to really understand the information that you're feeding into the program or that you're sending into your professional tax preparer, because you're not going to get an accurate return back if you don't present the information in a way that makes sense to the human or software. So it can still be a little bit tricky with our weird income as graduate students or postdocs. So the third option, as I just said, using a professional tax preparer or maybe handing your tax return off to your parents. I also see this very commonly. And so, of course, the issue with this is that you have to make sure that the person actually knows what they're doing. Your parents may be very competent at preparing their own tax returns. That doesn't mean they know everything that they need to know about your weird income and expenses as a graduate student or postdoc. Same thing with professionals. If you choose to use a professional tax preparer, I really encourage you to screen them before you pick which one you'll use exactly, to make sure that they are familiar with graduate student and postdoc income. That we'll go over a lot more of that later in the presentation. They're familiar with it, or at least they're willing to learn. So I'm going to so no matter which method you choose after finishing this webinar, I really hope and believe that this webinar will help you organize your thoughts around your tax return and present the information well to the software or the person that you're using, or help you, understand it well enough to do it yourself even. And I think that it is everyone's responsibility to understand the broad strokes of how income taxes work as sort of a civic duty kind of thing. So this webinar will help you a lot with that. That's my hope. I'm going to pause again and check the chat for any questions. Yes, so Brett is mentioning the VITA program. So yeah, I don't remember exactly what it stands for, but it's like volunteer income tax assistance. I kind of made that up, but it's something like that. So VITA programs are very commonly housed at universities and also some other sort of public spaces. And okay, thanks, Brett. Yeah, so they're often at universities, and they take volunteers and they train those volunteers, and then those people are sort of enabled to help low-income people with their tax returns. And so graduate students, postdocs, we definitely qualify as low income. So the good thing, it's great that that's available, but it all kind of comes down to the training of those volunteers. So personally, I heard when I was in graduate school, I talked with several of my peers who had gone to the VITA that was available at Duke for their tax returns, and their returns had been prepared improperly. And we'll go over kind of how you check that later on in the presentation. So that's not to say it's going to happen that way. It could be totally correct. It all just depends on how the volunteer has been prepared. But I think after you have finished going through this webinar, you are going to be able to understand if that person really understands what's going on, or if you're going to need to get a different person to help you or whatever. So it's sort of the same as using a professional. Like, they do have some training, but you have to make sure that you're working with the right person who has had sufficient training in this weird area. So I hope that that goes well. And I would certainly, if you want to, go ahead and try it out, but still, use caution. Don't just blindly trust the return that they get back to you. Same with if you used a professional. Okay, so no other questions have come in that I see, so we're going to move on. Okay, so here is where we get into really that specific stuff about your income as a graduate student or postdoc. So there are three types of pay that you might receive. The first category is employee type of pay. So if you're a graduate student, that's going to be from an assistantship. Teaching assistantship, research assistantship, graduate assistantship. If you're a postdoc, hopefully somewhere in your title or somewhere else you've been told that you are an employee, a proper employee of the university. So that's kind of one category together: assistantships for graduate students and employees for postdocs. And that will be paying your stipend or your salary, basically the money that you're taking home, whatever they might call it. The next category is often termed as fellowship income. It could also be income from a training grant, although I do hesitate to say that all training grant income is of this type, because it might fall under the employee type as well. So training grants are sort of split. But just so you know, if you're receiving a fellowship or if you're on a training grant, you may have this second type of income, whether you are a graduate student or a postdoc. And then the third category is scholarship income, and I'm kind of including, tuition waivers and tuition reductions and grants. Those are all different kinds of income that would fall under this scholarship type. And so the reason why you're receiving and scholarships, that category would only apply to graduate students. Postdocs should be out of that phase of life already. So why you're receiving this? Well, in the first category, you are doing work for your university and you are being paid for that work. You have an employer-employee relationship with your university. For graduate students, that would be in addition to your student relationship with your university. But the deal is you're doing work and you're getting paid for it. For the second type of income, the fellowship or training grant income, again, that will pay your take-home pay, that is an award that you're receiving. And same with the scholarship income, the funded aspect of being a graduate student, the tuition that's paid on your behalf, the fees that are paid on your behalf. Those are awards. And technically, according to the IRS, there's no work requirement tied to those awards. You are being given them based on your merit and status as a trainee. And we all know that that is completely crazy to say that there's no work required of someone who's receiving a fellowship, for example, or someone who's receiving scholarship income. But this is the distinction that the IRS and the universities have, come to for these different types of income. So the categories, the way that I'll be referring to these different types of incomes throughout the presentation is compensatory and non-compensatory. So compensatory pay is that assistantship, that employee pay, and non-compensatory is kind of everything else. The fellowships, the training grant, the scholarships, all non-compensatory. And the way that you actually for sure know what type of income, what type of pay you're receiving is by the tax forms that you receive or do not receive at the end of the year. So the one really, really definitive thing that I can say about this is that if you have that employer-employee relationship with your university, you will receive a W-2 at tax time, for sure. So if you receive W-2 pay, you can know that it's because of your assistantship, it's because you are an employee of the university, et cetera. You have that work requirement. The non-compensatory pay is really murky because the universities are not required to report non-compensatory pay in any particular way. So they do it in kinds of all sorts of different ways, and sometimes they don't do it at all. So I'll go over the different pay, the different reporting forms that I've seen as I've worked with universities around the country. So, okay, going back to your W-2 income, your compensatory income, this is what a W-2 looks like, and you'll see your income for 2017 there in box 1. So the first type of reporting that your university may use for your non-compensatory pay is the 1098-T. And the 1098-T looks like this, and box 5 is the relevant box for non-compensatory income. So your fellowship may go there, your scholarships, et cetera, may go there, the money that you're receiving for those types of things, box 5. Next possibility, and this is a rare one, is that universities may use the 1099 miscellaneous. 1099 miscellaneous looks like this, and your income, if it's for a fellowship or training grant, et cetera, would show up in box 3. That's very important because the 1099 miscellaneous is most often used for self-employment income, and that is box 7. So if you're receiving box 3 income on 1099 miscellaneous, and you know that you're receiving a fellowship or you're on a training grant or so forth, do not let anybody tell you that you're self-employed, because you are not, and that is a different box on the form, but some people just see 1099 miscellaneous and they assume self-employment. So that's another possibility, the 1099 miss, box 3. Third possibility for your take-home pay is to receive a courtesy letter. And this is just an informal letter that your university sends you that informs you of the amount of money you were paid for your fellowship, for example, for the year. So this is an example from Duke that I obtained from them, and it basically just says, hey, you received this amount of income, and we cannot give you any tax advice, so don't ask us. And then the final way that your non-compensatory pay might be reported is that it might not be reported. So as I said, the universities are not required to report it in any particular way. And so sometimes it just goes completely unreported. And I find this is especially the case for postdocs, because many universities will use the 1098-T for this type of reporting for graduate students, but in general, that's not an option for postdocs. So you may just have no reporting whatsoever for your non-compensatory pay throughout the year. And this causes obviously a lot of confusion for grad students and postdocs about whether or not that income is taxable. And I'm going to go into a lot more detail about which of it is and which of it isn't in the subsequent section. But for now, a really good place to look for potential income that you're not receiving any reporting for as a graduate student is in your student account. So this is a screenshot from my student account from back in 2012, in my couple years before I finished graduate school. And so you can see that from the transactions here that there were some, tuition and some certain fees charged, and then there were also amounts of money added to the account to pay for those. And so the amounts of money that were added to the account, that's what I'm referring to as scholarship income. That's the income that we need to that we've been considering in this previous section. Okay, so I'm going to pause again, check the chat. So add any questions you've had from this previous section. So A is asking, can I repeat 1099 box 3? And so I'll go back to that slide. What it was? Yeah, there it was. What is the question exactly? So as I said, this is a rare type of reporting that not many universities do. Duke is one who does things this way. And it's still for that fellowship, training grant category of income, but it's going to show up in box 3 of the 1099 miscellaneous. If you have a 1099 miss and you have box 7 income, that is self-employment income. So very, very unlikely that that's going to be related to your role as a graduate student. Box 3 is virtually always what we're dealing with when we're talking about grad student or postdoc income. I hope that answered your question, A, but if you have a more specific one, okay, great. And I'll just wait another couple moments in case there are any other questions coming in from this section before we move on. Okay, looks like we're all set here. So this upcoming section, calculating and reporting your grad student income or incomes. Oh, I see we had another question pop in about the 1098T. Go for it. Please ask your 1098T question. Yeah, non-residents may not receive a 1098T. That is possible. It doesn't mean that there wasn't income or expenses related to it. It just means that the university didn't generate it for you. If you have a follow-up question, feel free to add it. And then from Lena, are there any situations where scholarship fellowship funds are dispersed through the university payroll services and reported in W-2s? Well, I hate to say, never say never about anything like that, because the thing is that these labels of scholarship or fellowship or whatever are, they're not super strictly defined, and universities may use them a little bit differently, or funding agencies may use them a little bit differently. So I would say that to definitively figure out kind of what category you fall into, whether or not you receive a W-2 is the best one. So it doesn't matter as much what we call it as it does how it was reported, whether it was on a W-2 or whether it was on some kind of other form or not at all. That's the really big distinction I'm trying to draw here. W-2 versus not W-2 income. So yeah, maybe they could call something like that a scholarship or fellowship and put it on a W-2, I guess, but the important part is that it ended up on a W-2. Okay, I'm gonna wait just another couple moments and then we're gonna dive into this calculating income section. Okay, moving on now. Back to the slide we were just on, and here is a PhD comic. I hope you are all following PhD comics because Jorge Jam is a genius. All right, 2 grad students in a bar. Not very crowded here today. People must be rushing to file their taxes. I don't know why they wait till the last minute. I filed mine the first week of January. Awkward silence. Taxes are due this week? Yes, sir. There's nothing like counting how little you make a year to motivate you to work. And so we all have these kinds of thoughts and hang-ups about how little we make, and we love to grumble about that, and deservedly so, but we do have income and we do have to deal with it with respect to our taxes. So this is the section that I mentioned earlier that's going to be really complicated, and really heavy. And so postdocs, you can tune out for this. If you weren't a graduate student at all in 2017, you can tune out for this section. I'll tell you when to tune back in. This is going to be a long one. Graduate students, buckle up because there's a lot of detail in this section. If you are trying to prepare your return manually, this is really critical to pay attention to. If you're using tax software or a professional tax preparer, maybe you don't need to understand all the super details and nuances here, but I'm just going to give all that material, to the extent that you want to learn it, great, but it is going to be a lot, so fair warning. Let's move into this section. So this is how I see most graduate students handling their incomes, to report on their taxes. So, and this is how I did things for a while in graduate school. I saw my peers doing it in graduate school. Andrea has a stipend, or you could say a salary, it depends on the term that your university uses, of $30,000. That's the pay that she actually receives in her bank account, $30,000. And she reports that, pays tax on it, whether it ended up on a W-2, whether or not it was reported some other way, that's the income that she's reporting. But she totally ignores her scholarship income. Since she's a funded graduate student, she has some money that goes towards paying her tuition and her fees and so forth. She could have tracked that down on the 1098-T or in her student account transactions, but she just totally ignores it, doesn't check whether or not she should be paying additional tax or whether she's going to get a tax break, anything like that. She ignores it. She's just paying tax on her take-home pay. This is very common, but it is not the correct way to approach your tax return. So we're going to go into all the different correct ways there are to do this, where you don't ignore your scholarship income and so forth. Okay, so adding up your incomes, your total compensatory income is going to be on that W-2, right? But your non-compensatory income could be on the 1098-T and or 1099 miscellaneous and or a courtesy letter, and or you don't have any reporting and you have to look into your student account transactions. You have to look into what actually hit your bank account. All of those are possibilities. And when you add up as a graduate student, all of those income sources on the non-compensatory side, you may be thinking like, oh my gosh, my funding package was like, tens of thousands of dollars, like $50,000. Emily, I don't want to pay tax on all that income. Are you crazy? You are not going to end up paying tax on all of it because you're going to use your qualified education expenses, or QEEs, to reduce your tax burden. I'm going to go into all the details about how you do that in this upcoming section. So don't worry, we're going to be reducing that taxable income, but we're going to be reducing the tax liability, but we have to start by being aware of all of the different income sources that we have as graduate students. So there are 3 different education tax benefits that you might use your qualified education, by which you will use your qualified education expenses to reduce your tax burden. Okay, so the first one, the most subtle one, but probably also the most commonly used and most important one, is called tax-free scholarships and fellowships. And you can find all the details about it in Publication 970, Chapter 1, that's from the IRS. And so this is where you use your QEs to make some or all of your non-compensatory pay tax-free, your fellowship income, your scholarship income, etc. So you can make it tax-free. You can just directly net out QEs against your non-compensatory pay, net them out to zero, don't even report them, don't factor that into your calculations for your taxes. So I'll give you more details later, but that's the first and kind of most vital method for lowering your tax burden. So next possibility is to take the tuition fees deduction. There was a little bit of a hiccup with this earlier this year. So the tuition fees deduction originally expired at the end of 2016, but in early February, Congress passed the Bipartisan Budget Act of 2018, and they retroactively for 2017 extended the tuition fees deduction through 2017. So my favorite publication, Publication 970, does not, at the moment in its 2017 version, include the tuition and fees deduction because it had expired when the publication went to print. So I went back to the previous year, 2016 version of Publication 970 in Chapter 6 to find all the details about that tuition and fees deduction. So that's where I would point you if you want the more details about this. And so with the tuition and fees deduction, you make some or all of your pay tax-free, and there's a $4,000 limit on that. So as we went over earlier, deductions reduce your taxable income. That's what this one is doing. You take your QEs, you reduce your taxable income, capped at $4,000. The last one is the lifetime learning credit. Reference is Publication 970, Chapter 3. And so it's not a deduction, rather it's a credit. As we went over before, credits directly reduce your tax due. And so this is a 20% credit that's capped at $10,000 of QEs. So if you had $10,000 of QEs that were using for the lifetime learning credit, you would take $2,000 off your tax due. And again, I'm going to be explaining a lot more detail about these momentarily. You cannot take both the tuition fees deduction and the lifetime learning credit, but you can combine either one of them with making some of your non-compensatory pay tax-free. You can't use the same QEs for both of those purposes, but separate QEs, you can make some of your scholarships and fellowships tax-free, and you can also take either the tuition fees deduction or the lifetime learning credit. So these are the different combinations that are possible among these different education tax benefits. As I said, adding the tuition fees deduction kind of back in play for this year adds a degree of complexity to this choice. It was a lot easier in January when I thought that y'all would only have to consider making scholarships and fellowships tax-free and the lifetime learning credit, but there's another deduction on the table, so we're going to consider it. So along the diagonal here, the green squares, we have if you only applied one of these education tax benefits to your return. So that's a fairly simple situation. I'll go over those first. The blue squares are if you're applying two different education tax benefits and which one you would apply first. So for instance, in that first column, first you're going to make scholarships and fellowships tax-free, and then you're going to take either the tuition fees deduction or the lifetime learning credit. And the other blue box in the right-hand corner is when you apply the lifetime learning credit first, and then you follow up by making any further QEs that you have, using them to make your scholarships and fellowships tax-free. So I'm going to go over all these situations briefly so you can understand the different scenarios when they would actually apply. Okay, so we have our compensatory and non-compensatory pay all added together. The W-2 pay, the non-W-2 pay, all of it added together. And based on that high amount of income, we would calculate a large amount of tax due. But thankfully, we're not going to end up paying that much tax because we can use our QEs to reduce our tax burden. And the different benefits will apply the QEs in different ways. So first up, making scholarships and fellowships tax-free. So what happens is that these QEs, as I said, can directly net against non-compensatory pay. You can't do this against W-2 pay or compensatory pay. You can only do this against non-compensatory pay. So basically, they're going to exactly net out against each other. So you're reducing your taxable income by the amounts of those QEs. So it is a tax deduction, only works against scholarships and fellowships, and there's a unique definition of what qualifies as a QE. And I'm going to be going into those definitions as sort of the last part of this section. So that's going to reduce your tax due because you are reducing your taxable income by making that part of your non-compensatory pay tax-free. So Brandon has more scholarships than he has QEs. So his take-home pay, his stipend or his salary is $30,000, but then his funding, that's going towards paying his tuition and fees and so forth, that's $12,000, but the actual tuition fees and so forth that are qualified, the QEs, amount to $10,000. So what happens with him is he uses his $10,000 of QEs to make $10,000 of his scholarship income tax-free. And so he ends up with a total income of $32,000, those remaining scholarships plus his stipend, and that's what he's going to calculate his tax due from. So that's how that one works. If you need help with this calculation, Publication 970, Worksheet 1.1 is helpful for figuring out exactly how to do that, how to make some scholarships and fellowships tax-free. Next possibility is that you are taking only the tuition and fees deduction. So this goes against compensatory or non-compensatory pay, but you would only use it against compensatory pay. So you have compensatory pay and you have QEs and you have a large amount of tax due, but then when you apply those QEs, again, you're reducing your taxable income, you're reducing the ultimate amount of tax that you pay, and it's capped at $4,000, as I said earlier. So if you have more QEs than $4,000, you're not going to be able to, continue with that deduction. It's going to be capped at $4,000. And it has a slightly restricted definition of what a QE is, which I'll go over later again. And you have to file Form 8917 when you take the tuition and fees deduction. But again, it reduces your taxable income. So Curtis has a stipend. His take-home pay is $30,000. He has no scholarship income, so he's paying for his QEs out of pocket, out of his W-2 pay in this case. And so he is going to take his $4,000 of QEs and apply them to the tuition and fees deduction, and therefore he is going to calculate his tax due on ultimately $26,000 of income. Third possibility, you are applying only the lifetime learning credit. And so again, the credit will go directly against the tax due that you've calculated. So you have your compensatory, your non-compensatory pay, and your QEs. And in this case, you're not reducing your taxable income, but rather you're directly reducing your tax due. It's a 20% credit. So whatever amount of QEs you have, up to $10,000, multiply it by 20%, and that's the amount of tax you can take off your ultimate tax due. So if you get that full $10,000 of QEs that you apply to the lifetime learning credit, you'll take $2,000 off your tax due. Same definition of QEs as the tuition fees deduction, and you have to file Form 8863 for the lifetime learning credit. Okay, so Daniel has a stipend or take-home pay of $35,000. He doesn't have any scholarship income, and he has $10,000 of QEs. And so he's going to use all of his QEs towards the lifetime learning credit. He calculates his tax due on $35,000 of income, but then he's going to take $2,000 directly off of his tax due based on that credit. Okay, third scenario. First, you're making some scholarships and fellowships tax-free, and then you're going to take the tuition and fees deduction. So a person in this situation, Elizabeth, has more QEs than non-compensatory pay, okay? $32,000 stipend, $8,000 in scholarships, and $10,000 of QEs. So the first thing she does is she's going to make all of her scholarship tax-free, all of that $8,000 using $8,000 of her QEs. But she has another $2,000 of QEs, and so she's going to use those to take the tuition and fees deduction. Ultimately, she calculates her tax due on $30,000 of income after she's taken, after she's applied all those deductions and so forth. Next possibility, making scholarship and fellowship tax-free and then applying the lifetime learning credit. Very similar situation here. Fred has more QEs than non-compensatory pay, just like in the last scenario. So he's going to make all of his scholarships tax-free, and then he's going to use his remaining $2,000 of QEs to take the lifetime learning credit. So he's calculating his tax due on $32,000 of income, but then he's going to get that credit directly off his tax due of $400. Okay, last scenario that we'll go over, and this is the trickiest one. The one that your professional tax preparer or your tax software might not totally realize that you are eligible for. So if you're going to pay attention to any of these beyond the tax-free scholarships and fellowships, this is the one to pay attention to. So this is when you take the lifetime learning credit first, and then you take, and then you use any remaining QEs to make scholarships and fellowships tax-free. Okay, so Genevieve, in this scenario, she has a stipend or a salary of $30,000. $15,000 of scholarships and $12,000 of QEs. So she has both scholarships and QEs to contend with. First, she's going to use the lifetime learning credit for $10,000 of her $12,000 of QEs. Then she's going to use her next $2,000 of QEs to make $2,000 of her scholarships tax-free. So ultimately, she's calculating her tax due on $43,000 of income. But ultimately, she's going to take a tax credit off of her ultimate tax due of $2,000. So she had the option of using her QEs simply to reduce her scholarship income. And that in that scenario, she would have calculated her tax due off of an income of $33,000. But instead, she's doing this kind of little-known alternative method of applying the lifetime learning credit first. So she's ultimately reporting a higher income than she, could have, but she's taking this really large tax credit at the end of the process. So how do you know which is going to be more advantageous? And this is the question that we had earlier. Is it more advantageous to take the lifetime learning credit, or is it more advantageous to take some kind of deduction, whether that is making scholarships and fellowship tax-free, or maybe taking the tuition fees deduction over the lifetime learning credit? How do we figure out which is more advantageous to us? So you don't have to take the lifetime learning credit if you don't want to, but if you're willing to do the math and file Form 8863 and it's in your favor, of course, I would encourage you to do so. So there are a few factors that go into this. Ultimately, you're probably just going to have to do some math, but here are the factors that play into it. So what are the marginal tax brackets that you fall into at the federal, state, and local levels? Add all of those marginal tax brackets up together. If your combined marginal tax brackets at all of those levels are less than 20%, let's say it's 15% at the federal level, and then you have zero or rather low state and local marginal tax brackets that you fall into, then probably that 20% credit provided by the lifetime learning credit is going to be more valuable to you than taking a deduction. But you have to be a little bit careful here, because it's possible that your state and or city, and I know that there are some states that do things this way, it's possible that your state doesn't consider scholarship and fellowship income as the same type of income that they would ordinary income. So in some cases, this calculation might be thrown off because your state doesn't consider your scholarship and fellowship income as taxable income. So you have to be careful about that when you're looking at this. The total amount of QEs that you can use is different between the lifetime learning credit and the tuition and fees deduction. So in a scenario where, let's say you ended up with a slightly higher sum of your marginal tax brackets than 20%, so you're thinking, okay, maybe the tuition and fees deduction is more advantageous. Well, how much do you have in QEs that are available? Because you can use $10,000 of them for the lifetime learning credit, but only $4,000 for the tuition and fees deduction. So it may be more advantageous, to go with the lifetime learning credit just because you can use more of the QEs. And then the last consideration is that when you opt to report a higher income than you needed to, like Genevieve did in that last scenario that I showed you, she could have reported that lower income, but she opted to report a higher income and then take a large tax credit. You have to be really careful about that, because if there are any other tax benefits that you may have qualified for based on that lower income, but then you reported the higher income trying to take the lifetime learning credit, well, if you made yourself ineligible for those other tax benefits, then ultimately this might not be in your favor. So at the end of the day, these are a lot of different factors, but probably you're just going to have to do some math. Just prepare 2 draft tax returns if you're trying to figure out whether or not to prioritize the lifetime learning credit or whether to take the lifetime learning credit versus the tuition and fees deduction. At the end of the day, you're probably just going to have to do some math, but those are kind of the factors that will go into indicating which one might be better for you. Now, where do you find your QEs? The 1090-T, if you received one, is the first and best place to find your QEs. Either in box 1 or box 2, your university should use one or the other. QEs that are unambiguous QEs, there are QEs under every definition, will be found in box 1 or box 2. But you have to be a little bit careful, because if box 7 has been checked on your 1090-T, that means that you had some charges, some tuition charges, fee charges for, let's say, the first semester of 2018 that show up in your 2017 1098-T. So you have to be careful that you could potentially use those in either tax year. It's kind of your choice depending on when the money was actually paid, like when the money showed up to pay those tuition fees and so forth. But anyway, you may need to adjust the amounts you see in box 1 or box 2 if that box 7 has been checked. And so that's where going into your student account and actually looking at the transactions will be really useful, so you can figure out which ones these transactions were actually for 2017, which ones were for 2018, or the subsequent tax year. So that's what I mean by throwing this screenshot back up again. Check your actual transactions in your student account if you didn't receive a 1098-T, or if you're not really sure about the veracity of your 1098-T. Another good place to look for QEs, and so this is specifically for QEs that are for making scholarships and fellowships tax-free, are required course-related expenses. So fees, books, supplies, and equipment required. They have to be required of anyone in the course of study. So this is going to be like a textbook, for example, can be a QEE for the purpose of making scholarships and fellowships tax-free if you were not required to purchase it through your university. So let me go over a few more of these. For any of the education tax benefits, tuition is going to be a QE. Required fees, excluding health insurance premiums, excluding your student health fee, are going to be QEs. Required books, supplies, and equipment that had to be purchased from the university, these are all QEs under any of the 3 benefits that I went over earlier. And then the additional QEs that qualify as QEs for making scholarships and fellowships tax-free that wouldn't qualify for the tuition fees deduction or the lifetime learning credit are these ones. Insurance premiums if required for enrollment, and that's a very important clause. Required student health fees, and then again, as I just went over, those course-related expenses that were required of you, but you didn't have to purchase them through the university, you just had to purchase them from somewhere. So those are the various QEs. If you want like more of these definitions, I have an article on my website, What are Qualified Education Expenses? And you can also go to publication 970 under each of these benefits, and they very clearly list what are QEs and what are not QEs under each of these definitions. But again, tuition, required fees, aside from the health and insurance stuff, those are going to be QEs under any of the definitions. Okay, postdocs, come back. So for graduate students, step one, when we're actually preparing our tax returns, is to calculate your non-commensurate income net of the tax-free scholarships and fellowships that you have, the scholarships and fellowships you've decided to make tax-free using your QEs. Net those out, and the actual number that you're going to report is only after you've already done that calculation. So you don't have to tell the IRS, oh, well, I had this amount of income originally, but then I reduced it by this amount of QEs. With respect to tax-free scholarships and fellowships, you do not have to show them that calculation, although certainly I would, document it somehow. How did you do that math? So that's for graduate students. For everyone, for graduate students and postdocs, you then sum your total income, your compensatory income, that is your W-2 income, plus your net non-compensatory income. So postdocs, you could receive non-compensatory income in the form of your salary, if you're not an employee. And then for graduate students, it's going to be that, non-compensatory pay net of the scholarships and fellowships you made tax-free. That's what you're going to end up reporting. And then for graduate students, if you are taking the tuition and fees deduction or the lifetime learning credit, come to your return with those numbers and also have those forms that I mentioned earlier prepared. Really quick here, and then I'll pause for questions. So when you actually go to report your income on your tax return, this is the section of the 1040 that we're dealing with, the income section. And so your compensatory and your non-compensatory pay are going to be summed together, and they're going to go into line 7 of the 1040. All of your income, W-2 income, non-compensatory income, already after you've removed the tax-free scholarships and fellowships, that's all going to go into line 7 together. And if you are reporting any non-compensatory pay in that line, possibly in addition to compensatory pay, you're going to write SCH and the amount of that non-compensatory pay in the line next to line 7. So basically, when the IRS sees something entered in line 7, they are going to expect to see a W-2 related to that income. But you are just telling the IRS, oh, hey, there's not a W-2 associated with this income because this was scholarship or fellowship income in this amount. And the other, the lines for reporting your scholarship and fellowship income on the other 1040 versions that you might fill out are listed here. 1040A, 1040 Easy, and 1040 are the relevant ones for domestic grad students and postdocs. And in all cases, that is the wages line, the line where your W-2 income will go. Okay, I'm going to pause here because I know that was a lot and it was really complex and possibly far more detailed than you wanted, but I'm going to pause there for any additional questions. So we have one already. If your university also put your stipend on the 1090T, can you also defer that to 2018? No. So when I was referring to box 7, if that's checked, what that's talking about is the charges, the tuition charge, the fee charge, not the money that paid those expenses. So what's really important is when the money that paid those expenses showed up. So did it show up in 2017? Did it show up in 2018, 2016, whatever? Whatever year it showed up in, make that be kind of like the anchor. And then if you need to move the charges, like, let's say you received some money for tuition and that money showed up in 2018. But in your 2017 1090T, you see that the tuition charge, showed up in December or whatever of 2017. For the purposes of making that bit of scholarship income tax-free, you will be applying it sort of backwards, I guess you could say. You're going to be applying it to the charge that showed up in 2017. But you shouldn't try to take, an education tax benefit in both years for that tuition charge. Use it in the year where the scholarship showed up to pay for it. So the actual payments are the anchor and the charges themselves can be shifted across the tax year if that box 7 was checked, if it was for, the first few months of the subsequent tax year. So I hope that explained it. Next question, could you say more about when insurance premiums are required for enrollment as QE? So yes, this is a very tricky question. It's a very controversial question. And I can give you my opinion on it, but if you're really, trying to figure this out and consider it, I would actually look at very closely the documentation that your university provides, and also possibly call the IRS and ask. I have called the IRS and asked this question on a couple occasions, and I get different answers. So I'm going off of my plain reading. So if an insurance premium, health insurance premium, is required for enrollment, the fee is required for enrollment, that can be considered a QEE with respect to making scholarships and fellowships tax-free. So if you have a scholarship that pays your that pays your insurance premium, and that insurance premium was required for enrollment, this is the plain reading of the definition, that can be a qualified education expense for the purpose of making that bit of scholarship income tax-free. Insurance premiums are not considered QEs under the lifetime learning credit or the tuition fees deduction. So it's only for making scholarships and fellowships tax-free. What I think is tricky is the definition of required. So my interpretation of this, and again, I'm not a tax professional, this is my interpretation, is that if you were required to purchase that insurance through your university, then it was a required fee. If you had the option of having other insurance, like being on your parents' insurance, being on your spouse's insurance, purchasing insurance through an exchange, and that fulfilled the requirement, then I don't think that you can make the money that paid for that insurance premium tax-free. So I hope that distinction makes sense. Again, this is very tricky, very controversial, and just my opinion, but that's kind of the conclusion that I've come to. I would love to come to a different conclusion. So if anyone has like a really good argument, really good documentation about this, I have an article on my website. If you search on tfforphds.com for like insurance scholarship, I'm sure it'll come up. You can add a comment in there, join the debate about it. But different universities do handle this different ways. So if it was a scholarship that paid your insurance premium and that scholarship showed up on the 1080T and so forth, then it's a scholarship. Now, some universities might pay this through W-2 reporting, through like a payroll deduction. That's a totally different ballgame. So that's not what I'm talking about. That could be considered tax-free. So I'm really talking about if it's non-W-2 income that paid that insurance premium. Okay, I'm going to stop there. That was a long answer to a short question. I don't love the answer, as I said, so if you want to debate me, that's cool. That article is the best place to do it. Okay, you mentioned the people you knew did not always report the scholarship on 1080T. What did they do once they found out they needed to report it for the following year? I mean, I can't necessarily say what people did, but what you should do, perfectly ideal world, is if you find out that you made some kind of mistake on a previous tax return, you should file an amended return. And so you can do that. I don't know exactly how many years back it's possible to go. I don't know the number off the top of my head, but you can file an amended tax return. And so this would especially be a good idea if, for instance, I talk to students who do this all the time, you had multiple years of fellowship income, so your take-home pay that you didn't pay tax on for like many, many years, that ends up being a really large tax bill, and it's a tough pill to swallow to pay that after not doing it for several years, to file those amended returns. But it's better to own up to it than the IRS to kind of catch you having not paid that kind of thing for years on end, because the fees add up, the penalties add up. So best thing to do if you figure out you made some kind of mistake is to file an amended return. Okay, next question. For the 1040 box 7, I'm confused whether we report non-commensurate income before or after we subtract QEs. Yes, very important point to clarify. So what goes into line 7 of the 1040 is your income, your non-commensurate income, net of the QEs that you use to make some of it tax-free. So if you had, $12,000 in scholarship income and you had $10,000 of QEs, you're only going to put that $2,000, and you decided to, use them to make your income tax-free, you're only going to report $2,000 in that line 7 plus your compensatory pay. So it's after you've done that subtraction already. Making scholarships and fellowship tax-free happens kind of off your return. It's a calculation you do behind the scenes before you do the reporting. And again, you don't have to tell the IRS about your math, but keep the documentation because it may, come in handy later if they ever question you on it. So it's net, after you have made some or all of your non-compensatory pay tax-free. So for instance, for someone who has exactly the same amount, like tuition. So their tuition was $5,000 and they received exactly a $5,000 scholarship to pay the tuition. Those net out exactly to zero. No additional number needs to appear in line 7 for that because they netted out exactly to zero. Okay, I was teaching in fall 2017. I only received W-2 form. Is that the only form I should fill? So if you were a graduate student and you did not receive any funding, like to pay your tuition and pay your fees and so forth, if you paid those yourself, or if you didn't have any for some reason, which I would question how that could be the case, then the W-2 is the only one you have to deal with. But most likely as a graduate student, a funded graduate student, you have some of this other income and some of these QEs to deal with. You may not receive documentation about it, but they exist somewhere, probably in your student accounts. That would be the place to track them down. In the examples you gave, all the QEs are about $10,000. On my 1090T, I have $40,000 in box 2, $44,000 in box 5. Do I have 40K in QEs, or is it capped at the 10K? So for the purposes of making your, so if you want to use your $40,000 of QEs to make that income in box 5 tax-free, the net is $4,000 in your case. So 44,000 minus 40,000 is 4,000. And so that would be the easiest thing to do. Very simple calculation. You report an additional $4,000 income, that's it. If you wanted to take the lifetime learning credit, for example, first, you would use $10,000 of the QEs for that. And then you have that $30,000 of QEs left, and you can apply those against the 44K. So I hope that made sense. Can I review the last option again? Lifetime learning credit and then making scholarships and fellowship paid tax-free with remaining QEs. Yes, I'll go back to that slide and I will just leave it up for you to examine in a little bit more detail. Lena says 3 years from the day you initially filed is the limit for filing an amended return. Thank you for adding that. From Nate, is there a way to add scholarship and the amount of income on the fillable PDF from the IRS, or do you need to print the form out and write it in? So I believe, if I remember correctly, with the fillable PDFs from the IRS, it gives you the option of having the SCH be printed there. I don't think it gives the option of writing the amount. That's okay. The amount is not required. The SCH is required. The amount is just helpful. So consider the amount optional. And I do think that fillable forms do the SCH part. Okay, Brett, I received a 1099-T, I think you meant 1098-T, which reported my tuition waiver and tuition charges equal amounts with box 7 checked. It didn't feature my stipend. I don't have any QEs aside from my tuition, so I just reported both my stipend and tuition as income, and then use the tuition as a QE, make the tuition waiver tax-free, leave me with just my stipend as taxable income. Does that sound correct? Yes, it does, except for the part about box 7 being checked. So what may have happened is, if you are multiple years into your graduate education, if your university does that box 7 checking every year, it may have happened that in the first year you were a graduate student, like that first fall, you may have had like double tuition charge show up on your 1098-T, and then it'll kind of play forward throughout the whole time you're in graduate school. And then in the last year, you're going to have like no tuition charge and just the scholarship show up. So it doesn't sound like it's causing you any problems this year, but it may cause you problems in a different year. But I think as long as you are just trying to be accurate, reporting everything accurately, and you're sort of intuitively pulling that charge across the calendar year, then it was probably okay. But it does sound correct for this year. The difference between box 2 and 7 on my 1098-T is only $20 grad student activity fee paid by myself. Do I need to report it anywhere? So I think you meant box 5. And if you did mean box 5, then technically, yes. So if you want to make as much of what shows up in box 5 tax-free as possible using what shows up in box 2, and you have a net plus $20 of income there, that plus $20 needs to go into line 7 on your 1040, in addition to what other pay you have. Okay, I got through the list of questions. Let's move on. I'm actually going to hold questions for the rest of the presentation, but then I will get back to answering them during the final Q&A at the end. I just want to not take too much longer than an hour to get through all of this material. So let's speed through the next few sections. So please hold your questions to the end, but I'm happy to answer them at that time. Okay. Paying your income tax throughout the year. Another comic here. Our ads promise you the biggest tax refund possible. So we're instructing your employer to withhold 300% of your paycheck this year. So this little joke is about, tax withholding versus actual tax due. So you may enjoy, for example, receiving a large tax refund after you file your return each year, but all that means is that you had a lot more tax withheld than you actually owed. And so you're only getting back the interest-free loan that you gave to the IRS throughout the course of the year. So for paying tax throughout the year, compensatory pay and non-compensatory pay. For compensatory pay, you are definitely going to have taxes automatically withheld from that W-2 income. Your employer, your university, will certainly have pressed you to file a W-4 with them, so they know how much to have withheld from your income. And so the income that you actually receive in your bank account or whatever is net of taxes. It's after you've already had taxes withheld. Now, some people receiving non-compensatory pay also have the option of having taxes withheld. I know this was the case for me at Duke, and Duke is one of the few institutions that I've come across that do offer tax withholding on non-compensatory pay, on non-compensatory stipends. So it does happen from time to time, but it's not very common. But if you have the option, if you have non-compensatory pay and you have the option of having tax withheld, I think it's a great idea, because then you can avoid the mess that I'm going to talk about now, which is if you are not having tax withheld on your non-compensatory pay. This is really confusing. Some people think that just because you're not having tax withheld, that means you don't actually have any tax due. It's not true. It's just that your university is not helping you out by paying your tax due throughout the year. So my suggestion, if you are in the situation where from your stipend or from your salary, you're not having anything withheld, and that's because you're receiving non-compensatory pay, then I recommend setting up sort of your own system of self-withholding. So for example, with every paycheck that you receive, you set aside in a dedicated savings account the fraction of that income that you will ultimately pay in tax. And so that way, when you ultimately pay your tax, it's not going to be a shock to your budget to come up with that amount of money. You can just access it in that dedicated savings account. So set up your sort of own system of withholding. Now, if you're not having taxes withheld, the IRS does expect to receive money throughout the year from you. And so you may be responsible for paying quarterly estimated tax, which I'll go over next. It's also possible that you are not responsible for paying quarterly estimated tax. And in that case, you just need to, with the ultimate tax return you file in the spring every year, to settle up and pay whatever additional tax you have due at that time. But I'll go over how you kind of figure out whether or not you have the responsibility of filing quarterly. And that's using this really helpful flowchart from publication 505. So the kind of takeaway point from this is that if you are going to owe more than $1,000 at the end of the year when you file your yearly tax return, if you're going to owe more than $1,000 and you don't fall into one of a couple different exception categories, which the form that I talk about next will help you figure out. So if you owe more than $1,000, you were most likely required to pay quarterly estimated tax unless you fell into an exception category. So the way that you figure this out and also pay your quarterly estimated tax, if you are responsible for doing it, is using Form 1040-ES. And so with 1040-ES, you're going to do a really high-level draft of your taxes for the year. It's not going to get into a super lot of nuances, just going to be really high-level, what's kind of your income more or less for the year, deductions, exemptions, and so forth. So draft of your taxes, and you'll figure out how much tax you have due at the end of the year. Again, that trigger point is if it's more or less than $1,000. If it's more than $1,000, most likely you were required to pay quarterly. You will be required to pay quarterly estimated tax. So the way you do that is you send in a quarter of that ultimate, tax that you calculate due for the year every quarter, and you can do that online at irs.gov/payment. So it's actually pretty easy. And the due dates are a little bit wonky. They're not every 3 months. They are mid-April, mid-June, mid-September, and mid-January of every year. So if, right now you're preparing your 2017 tax return and you're like, oh my gosh, I owe more than $1,000, this year, and you have the same funding situation for the upcoming year, 2018, that's an indication that you probably will need to be paying quarterly estimated tax in 2018. So filling out Form 1040-ES and sending in those payments periodically, that is, unless your funding source changes and you have tax withholding available to you again. And if you want more help with this, I am holding a workshop in the first week of April. I haven't scheduled it yet, but you can register for it at the URL that's on the screen right now. And so kind of the purpose of the workshop is to help you actually file, make that payment of your quarterly estimated tax for quarter one in 2018. So basically what's going to happen is it's scheduled for an hour, but that's just to put it on your calendar for an hour. Show up. I'm going to teach for 10, 15 minutes, something like that. We're going to walk through Form 1040 ES together, and then everybody on the call all at once, you're going to do your calculations and actually go ahead and make your payment. And I will be available for any questions that come up. So it should be kind of a community, a communal approach to checking that task off of your to-do list. And so hopefully that'll make it a little bit less intimidating, because you know that I'll be available to help answer questions. So you can register for the workshop at that URL. Okay, the couple featured tax lies that I mentioned at the beginning. I have a series of 10 tax lies for graduate students, but a lot of these apply to postdocs as well, on my website. And I'm just going to tell you about 2 of them really briefly. So the first one is regarding individual retirement arrangements, or IRAs. IRAs are great. I totally encourage you to start saving for retirement when you're in graduate school, when you're in your postdoc. It's great to get started early. A big focus of what I teach within my personal finance content is on investing and on getting started early. So I love the IRA. Go ahead and use it. However, not everyone is eligible to use an IRA. So you need compensatory pay to contribute to an IRA, and the limit for contribution is $5,500 or the amount of your compensatory pay, whichever is lower. Non-compensatory pay is not eligible to be contributed to an IRA. So if you go an entire calendar year, 2017 for example, and you only have non-compensatory pay, you only had fellowship income, no W-2 pay from your role as a graduate student or postdoc, no outside income, and you were not married to someone with compensatory pay, then you would not be eligible to contribute to an IRA in that year, 2017. Sucks. It's bad news. I don't like that this reverse loophole exists. I wish it would change. But that is, the rule that's in place right now. So if you go a whole calendar year without any compensatory pay, you're not eligible to contribute to an IRA in that year, and you're not married to someone with compensatory pay. Doesn't mean you can't save for retirement. It just means that you can't use an IRA. Next tax lie is regarding the saver's credit, which if you are saving for retirement, for example, and you have a low income, like you're in graduate school, but you manage it and you're able to do that savings, you might be told, hey, you can take the saver's credit because you have that low income and you're still saving. Like, good for you. It is good for you, but you are not going to be able to take the saver's credit because if you're in graduate school, you are a full-time student for at least 5 calendar months out of the year. So postdocs, not considered students, would be able to take the saver's credit if your income was under these limits, which are $31,000 for a single person, $62,000 for a married couple filing jointly. That's the maximum income where you'd be able to take any component of the saver's credit. So something to look out for if you're not a student, but if you are a student, bad news, you're not eligible for it. Okay. Last section here on the changes that are upcoming for 2018. Well, they're already in place for 2018 that you'll be dealing with when you file your 2018 tax returns. So the first thing I want to say is, we really dodged a bullet there as a graduate student community with the original House version of the tax reform law that was ultimately passed in December. There were some changes that would have increase the taxable income for a lot of graduate students. And thanks to, grassroots activism and through some of the advocacy organizations in place for higher education, those changes did not make it into the ultimate bill. So if you were participating in that and you're as an activist, like you called your representatives and so forth, thank you for doing that. We dodged a bullet on the student side of things anyway. So thanks for your work on that. However, there are some changes that went through ultimately in the bill for 2018 that kind of affect everyone. And so I'll go over the ones that might be relevant to graduate students and postdocs. So the tax bracket shifted up a little bit, only slightly at lower incomes. And I'll go over exactly what those shifts are momentarily. There is a larger standard deduction available. So it's almost double what it was in 2017. But there are no longer any exemptions. So as I said at the beginning of this presentation, in 2017, you can take a standard deduction, you can take an exemption. Those both reduce your taxable income. Well, in 2018, you're going to have a larger standard deduction available to you, but no exemptions. So if you have older children, for example, this could be bad news because you no longer have their exemptions available on your tax return. If you have younger children, under the age of 17, there is a larger tax credit available. So it used to be $1,000 tax credit for each qualifying child. Now it's up to $2,000, and it's refundable up to $1,400. So good news for those of you who have young children. And then also on the itemized deductions, there are now certain caps and limitations and changes that were made to like the state and local taxes, the mortgage interest deduction, those kinds of things. This sort of really affects certain states more than others, California, New York, New Jersey, for example. In any case, I don't think it would be typical that graduate students or postdocs would be affected by those changes because, as I said earlier, you're probably not itemizing your deductions. And if you are, you probably didn't have, up to the new limits on these changes to the itemized deductions. But, maybe if some of you could be in that situation. So it's certainly something to be aware of for your 2018 return. Okay, so let's compare how much tax you would pay on a $30,000 income in 2017 versus 2018. So again, let's say you had a total income of $30,000 in either year. First thing that happens is you do your above the line deductions. I'm going to not consider those for the time being, and we'll skip straight to the standard deduction. So in 2017, for a single person, $6,350, and in 2018, it's now almost doubled up to $12,000. So all of that income not taxable. Great, good news. But the next step is applying those exemptions, which the exemption would only apply for 2017. In 2018, there's no exemption in place. And so now your taxable income has been reduced to, for 2017, $19,600, and for 2018, $18,000. So in this example, for a single person with $30,000 of income, you have a slightly lower taxable income in 2018 than you did in 2017. Another change is to the marginal tax brackets. So there's still a 10% marginal tax bracket for both years, but the 15% tax bracket has come down, come down to 12%. Likewise, the 25% tax bracket has come down to 22%. And so when you run these numbers on this hypothetical example, in 2017, you would have paid almost $2,500 in tax. In 2018, you would ultimately be paying almost $2,000 in tax. So about a $500 reduction in tax due between these 2 years for this hypothetical set of numbers here. And I ran some quick calculations on a range of gross incomes that may be relevant to graduate students and postdocs for single people and for people married to other people with higher incomes. And I calculated just based on them taking the standard deduction both in 2017 and in 2018, and also not having any children. So a lot of assumptions going into this, but I calculated how much their tax bill would come down from 2017 to 2018 with these particular ranges of incomes. And it was pretty much between usually like 20 and 35% across the board. So if you're not experiencing some of those changes to your itemized deductions that I mentioned earlier, probably your tax bill will be less in 2018 than 2017, I would imagine, if you're taking the standard deduction. Okay, summary slide. We're here at the end now. So here's what you need to do for your tax return this year. Identify if you have compensatory pay, W-2, and or non-compensatory pay, all other reporting. So it's really important to track down all those different income sources. Calculate and report all of your income. Don't ignore some component of it because you find it, inconvenient or confusing. Use your qualified education expenses for graduate students to reduce your taxable income and or your tax due using up to two of the three education benefits that I covered earlier. 4, check that your compensatory and your non-compensatory pay both go into line 7 of the 1040 where the W-2 goes. This is really important. I think it's a very easy way to check a return that's been prepared for you by tax software or by a professional tax preparer. If your non-compensatory pay, for instance, ended up anywhere other than line 7 of the 1040, that's a big red flag that something has gone wrong in the preparation process, and you need to, go back and address whatever it was that happened. 5th, if you are receiving a non-compensatory stipend or salary, most likely you'll owe quarterly estimated tax on that. And so figure out if you do, and then if you do, follow through and pay it. And I'm available to help you with that if you're not sure how to do it. And then the last one, check that your income type does not qualify you from certain tax advantages. So if you're not eligible for an IRA, for example, or whether you're not eligible for the Savers Credit, and there are other ones that apply sort of under that category as well. Okay, that's a summary. And you have here my contact information and my various online presences. So Personal Finance for PhDs, paforphds.com is my main website. I also have 2 database websites for stipends and for salaries for postdocs. The postdoc salaries one just launched like last week, I think it was. There's already like over 800 entries in there, so that's amazing. PhD stipends has about around $4,000 entries in it right now. So if you haven't been to those sites before, I would love for you to check them out, add your own incomes and benefits and so forth in there and share so that the database can expand. And then evolvingpf.com is the blog that I started regarding, personal finance while I was in graduate school. It's kind of how I got started on this journey of, becoming passionate about personal finance and ultimately making it my my job now. So you can go check that out it's very personal, but there's a lot of documentation from the time when I was in graduate school and talking about my own money at that point. I don't update it too much anymore, but it's still there for you to check out the archives. And I'm going to return to answering questions now. And I'm actually going to come on video. Hi, y'all. And yeah, continue answering questions. So I'm going to go to the chat. So add your questions there if you have any. Okay, Brett. Isn't there more to calculating AGI than just taking the lesser of $5,500 or your compensatory income? Are you talking about your contribution limit to an IRA, Brett? Let me see if there's an update. No. So clarify that. So there are other possible limits to your contribution to an IRA, particularly to a traditional IRA, and there are income limits on it. And so as I said at the beginning of the presentation, I'm not considering the possibility that you will exceed those income limits because, I'm assuming you have a low income as a graduate student or postdoc. But yes, if you have a higher income than is typical for a graduate student or postdoc, then you definitely need to check out whether or not your income, hits those levels and that you would be disqualified from contribution IRA. For sure, you should check that out, yes. From Lena, can I talk about a student FICA tax exemption? Who's eligible? What to do if it was incorrectly withheld? Okay, yeah, this is a great question. So the FICA exemption, there's 2 ways you can not pay FICA tax. The first one is if you are a graduate student and your employment is, as an assistant or have an assistantship or whatever, if it's related to your role as a graduate student and not the fact that you are, for instance, primarily an employee and secondarily a student. So assuming that you're primarily a student and secondarily an employee, you do have a FICA exemption available on your income. So you shouldn't be paying FICA. I have seen in a couple cases, and different states do this different ways. So it's possible, if you attend a public university, this may end up being an issue. I have seen that sometimes FICA is taken out of grad student income during terms when it can be argued that those students are primarily employees and not primarily students. So I hope that makes sense. So like, for instance, if you are over the summer and you're like not taking classes, you may be not primarily considered a student. And so that's kind of a weird thing. I'm not sure what you would do exactly if you think that you have been, if FICA has been taken out incorrectly. I would first address that with your university, the people who are preparing your W-2 or whatever, and figure out if they can file, an amended W-2, and then you can get that money back. That would be the first kind of stop. And then if that doesn't work, I would say call the IRS helpline and ask them to, what can be done to resolve this situation if it was incorrect. But I just want to warn you that in some cases I have seen it, be applied and you couldn't argue that it was incorrect, that it actually was correct that that student was paying FICA at that time because they weren't primarily being considered a student. It's very weird, but I've seen that come up a couple times. Okay. From Maddie, is it valid to file your taxes in your home state The consideration being that you're in your university state for educational purposes only. I'm in that limited, the liminal space of quasi-adulthood still. I'm finding myself in that situation. This is a really good question. I think a very common one. So thank you for asking it. I obviously didn't address state taxes in this presentation, but it is a question that I get from time to time. The quick answer is no. So you need to, in general, you need to file state income tax for the state in which you earned the income. There's an exception to that, which is that some states have a reciprocal tax agreement with other states. So for example, it's very common for people to commute across state boundaries. So I grew up in Northern Virginia, so like it's very common for people to live in Virginia and work in Maryland or DC or vice versa, all kinds of ways around. And so in those cases, those states have reciprocal tax agreements with one another. And so you can live in one state and file taxes in that state, even though you earned income in the other state. But what's more common for graduate students and for postdocs is that you moved at some point during the year, or maybe this is even in a year when you didn't move, you moved in a previous year. But in the year that you move, if it's intended to be like a long-term move, like you're going to be living there for the course of your PhD, like 5 years or whatever, then in most cases, you would be considered a part-year resident of each one of those states. So the state you move from and the state you move to, you'd be a part-year resident in that year for each of those states. And then in subsequent years, you would be filing taxes only in the state that you actually live in. And so the argument for like that college students get to make, where like they, may actually live with their parents, whatever, does not really apply in this case because you are earning money. And so what matters is that you're filing taxes where you earned your income. Okay, from Jenkins, 14% of my stipends withheld because I'm international. I also didn't get a choose. So how do I calculate my income? Should I be aware of how much I've already had withheld? You should receive a 1042-S. Again, this presentation didn't address international student taxes, so you would need a lot more information than what I presented today. But the 1042-S should help you with this. And it's what has happened to you is totally common, that a lot of taxes withheld, and you should, be getting a good amount of it back probably. Anyway, use your 1042-S to help you with that. From Jacob, 1 is whatever is on our W-2 equal to compensatory pay. Yes, that's my argument. If we are already having taxes withheld, should we report gross income or net income? So your W-2, in which you'll have taxes withheld, in box 1 is going to appear your gross income, your total income. And that is the income that you will put into line 7 of your 1040 or whatever line it is on whatever 1040 equivalent form you're filling out. And then in a separate box, I don't remember which box it is on W-2, but they have separate boxes that are there for the withholding that you've had done at the federal and the state, and if applicable, the local level. And those will also go onto your tax return as taxes you've already paid. And so you'll be working with your gross income and then the tax you paid as separate amounts. And then ultimately you'll figure out whether or not you are going to get a refund or whether or not you're going to owe more tax. Okay, from Ban, just to make sure, stipend money is non-compensatory, should be reported along with my W-2 compensatory. I'll back off a little bit from the term stipend because different universities use the term stipend in different ways. The non-compensatory income is the income that's not reported on the W-2. However you want it, look, whatever they call it, if it's a stipend, if it's a fellowship, if it's training grant income, whatever it is, if it's not reported on a W-2, that's your non-compensatory pay. But yes, you ultimately will add your non-compensatory pay net of, the scholarships and fellowships you've chosen to make tax-free, along with your compensatory pay, add those together, and those will both go into line 7 of your 1040. Okay, from Nate. If I receive our income in 1 or 2 annual lump sums, will I still be paying estimated tax in multiple payments throughout the year or just once after each payment? I don't think I've ever gotten that question before. Probably each is okay, but to be on the safe side, I would say do it in the quarters when you immediately, like if you receive that lump sum in January, then make your quarterly estimated tax payment for quarter 1. I would imagine that would be the best way to go about things. I don't know if it matters too much, but that's my guess. Oops. Sorry about that. If non-compensatory pay exceeds, this is from Kristen, if non-compensatory pay exceeds QEs, can we take the lifetime learning credit? If so, can you explain how that works? If non-compensatory pay exceeds QEs, yes, you can take the lifetime learning credit. So this is the example that I showed with Genevieve. And so I think what you should do is when I send out the recording of this webinar, you should go back and rewatch that section about the lifetime learning credit. So you would be taking the lifetime learning credit first using up to $10,000 of your QEs. And then if you have any remaining QEs above $10,000, you can use this to make your non-compensatory pay tax-free of that equal amount. So that's how that would work. But I explained it a little bit more in that section. From Monica, what am I supposed to do with money on line 12A? DD of my W-2 doesn't need to be reported somewhere. I don't remember what line 12A is. Can you, DD, is that the health insurance one? If you have any more information about that, let me know, because I just don't remember off the top of my head what line 12A means, but send it if you have it, or you can follow up with me over email and I'll try to help you with it when I can, when I have it in front of me and can look at it, look at the instructions and so forth. Yes, health insurance. Let me kick that question. Follow up with me over email, emily@pfforphds.com, and I will help you with that there, because I don't remember exactly what to do with it. 1095B health insurance sent to me by the university used anywhere in filing. I don't think I heard it mentioned. I also did not talk about that. So this is great. Thank you for these questions. I should be more versed in this part. So I will look up these two questions and please email me to follow up. And I may post an article about it at some point, but probably for when you're needing to file your return, you want a quicker answer. So just follow up with me over email. Okay, I'm gonna wait a few more minutes. I have a little bit more time, so I'm just gonna wait and see if any questions come in. But for those of you who are still here, thank you so much for attending, for sticking around until the end. And I hope you got something out of this. And of course, you're welcome to watch the recording once I send it out as well. Yes, okay, you're welcome. To those of you who are saying thanks, thank you for coming. Glad to have you part of my sphere now, and please keep in touch over email. You're on my email list now, so you should be hearing from me periodically. You're welcome, thanks. You're welcome. I'm just going to continue to wait until everybody signs off to make sure I capture any last questions, but looks like this might be the end. So you're welcome for doing it for free. I don't know how many more years I'm going to do this for free, but for now it is, so enjoy. Okay, from Mackie, could I claim tuition for my child for deduction? Oops, clicking my screen. Yes, please add your question, Jacob. So could I claim my tuition for my child for a deduction? So yes, I mean, if you have a dependent child and you are paying tuition expenses and so forth for that child, this is not something I covered, but you can consider taking a deduction. You can consider taking the American Opportunity Credit. That's usually the most lucrative education tax deduction to take. It's not one I covered because it's only available for students in their undergraduate years, not in their graduate school years. But yeah, so I didn't go over that, but please look into it further. Absolutely, if you paid those expenses, you should be able to take some kind of education tax benefit for them. Okay, so I'm waiting on Jacob's question, and there are still 12 people here. So 12 people, if you have questions, add them now. Okay, from Bill. Yeah, we had someone at HR Block come to talk to us by the GSA EL, was completely uninformed. This is much better, thanks. Oh, thank you very much for saying that. I actually noticed the last couple of days there was a huge influx of registration for this webinar from Yale students. I don't know how this information got shared there, but I had the same experience when I was in graduate school. I went to a couple tax seminars that were put on by the administration at the school. And it just was clear to me, I knew enough about taxes at that point that it was clear to me that, these people, although they were tax professionals and they were much more qualified than I am, they didn't really know the audience. They didn't really know the particular needs, the particular strange situations that graduate students and postdocs get into. So that's why, I went down this route and decided to start providing this information myself. For the future, for next year or something, I give seminars. I've never spoken at Yale, although I've been in contact with people there from time to time. But through the GSA or through another group at Yale, if you want to get me invited, I do speak, and it's kind of the main component of my business. So I would love to come or do a webinar or whatever. If you think that this seminar would be useful for the students and or one of the other seminars I do, get in touch with me through email if you want to follow up more about that. Okay, from Jacob. Okay, so my W-2 wages are listed as about half of my stipend, and in my paycheck, taxes are withheld as well. Taxes are withheld as well as state and taxes on the W-2. Okay, so Jacob, follow up, like what is exactly your question here? You're wondering like why you don't have any forms associated with the other half of your stipend, or like are you asking about filing quarterly estimated tax, or like where is this question going exactly? Totally follow up and I'll try to help you. From Bill, the same specific questions they couldn't answer. I will let the Yale GSA know. Okay, thank you so much. And yeah, feel free to email me or have them email me and follow up about that. And of course, once you receive this recording, I mean, you can share it with them. Of course, I would love to actually get a paid booking instead of providing all this for free from time to time. I've done 3 tax webinars or tax seminars so far this spring for a few other universities. So it is something that they're willing to pay for. But yeah, for individuals, I want to provide this for free. But thank you, Bill, for doing that. Yeah. So Jacob, follow up with your question. And there's still 8 people on the call. 8 people. Do you have remaining questions? Are you just wanting to not miss anything here at the end? I'm going to wait until pretty much everyone's off. So, okay, so Jacob, you think you figured out maybe, totally go ahead and email me if you want to provide more detail, whatever. That's perfectly fine. We can even hop on a call if you want to. Yeah. Okay. Yeah, you're welcome, Jacob. You're welcome. Yeah.